Welcome to our companion podcast on important family business matters, Family Business Briefs, with our AI hosts, Jen and Ted. The content in these episodes comes directly from Family Enterprise USA and can be found at familyenterpriseusa.com. As we all know, many issues like taxes, economic policies, and new legislation affecting family businesses are complex. So, with the assistance of AI and our AI hosts, Jen and Ted, this technology helps make sense of it all in a brief, clear, and lively discussion, and all in about 10 minutes. We hope you find the information presented here useful and entertaining. Now, let's listen in on this episode's important family business topic.
When we think about who really shoulders the tax burden in the U.S., especially federal income taxes, what comes to mind?
Is it that image of the super rich?
Yeah.
Or maybe like massive corporations?
Exactly. Today, we're digging into a special report. It's from Pat Soldano, who heads up Family Enterprise USA.
Right. And her report zeroes in on exactly who is contributing the most in federal income taxes.
With a particular focus, it seems, on high-income individuals and also those, well, often overlooked, family-owned businesses.
Precisely. Our goal in this deep dive is really to get beyond the headlines, the usual talking points.
We want to unpack the actual data,
Yeah.
understand the reality of who's paying what in federal income tax.
And you should probably prepare for some potentially surprising information. It's really crucial stuff for understanding current economic discussions, policy decisions, too.
Okay, so let's just dive right in. Let's tackle that really common idea out there, the feeling that the rich aren't paying their, quote, fair share.
That narrative often puts a spotlight on successful families, right? And the businesses they've built, sometimes over generations.
It's a sentiment we hear a lot. And look, there are certainly valid discussions around fairness within our progressive tax system.
Oh, absolutely.
Oh.
And the ongoing issue of wealth inequality. These are important societal conversations, no doubt.
However, when we're talking specifically about federal income tax contribution, it's vital that we look at what the data actually tells us.
Which takes us straight to some pretty compelling numbers.
Okay.
According to IRS data from 2022, the top 1% of earners in the U.S., they paid a staggering 45.8% of all federal income taxes.
Wow. 45.8%. Let that sink in for a second. Almost half of all federal income tax revenue came from just the top 1%.
And what's particularly interesting about that figure is that IRS data consistently shows this group, the top 1%. They don't just contribute the largest total amount, they also pay the highest average personal income tax rates.
So it's not just that there's a lot of income at the top.
Right. They're also taxed at a higher rate on that income. You could say the system is, well, it's designed to be progressive.
Yes.
At least when it comes to federal income tax.
Now, the report also shines a light on something we might not always think about in these discussions: family-owned businesses. We often picture these huge corporations when we talk about the economy, right?
Sure.
But in reality, family-owned businesses are the largest private sector employer in the country.
That's a massive part of our economic landscape. It really is.
And what's really relevant for our tax conversation is how they're structured.
Exactly. About 80% of these family-owned businesses aren't structured like those big publicly traded corporations.
Okay.
Instead, they operate as what are called pass-through entities.
Pass-through. So like the business's profits are passed through directly to the owner's personal income for tax purposes.
You got it. Think sole proprietorships, partnerships, LLCs. I mean, they're the backbone of a lot of local economies.
Okay, pass-through entities. So how does that actually affect how they're taxed? This is where that Section 199A deduction comes into play, isn't it?
Exactly. Current tax law includes this provision, Section 199A. It allows owners of these pass-through businesses to deduct up to 20% of their qualified business income.
Right. And the idea behind that was?
Well, the idea was to try and create a bit more parity, between the tax rates on income from these pass-throughs and the rates on traditional corporations.
So if the top individual income tax rate is, say, 37%, this deduction effectively brings the rate on that qualified business income down, makes it closer to the corporate tax rate, which is 21%, plus whatever taxes shareholders pay on dividends.
It's aiming to sort of level the playing field for these businesses, many of which are significant job creators.
Precisely. It's a mechanism intended to support these significant contributors to employment.
However, and this is a really important point to keep in mind, this Section 199A deduction, it's scheduled to expire at the end of this year, 2025.
Unless Congress takes action.
Unless Congress acts. That's a potentially major tax shift right there on the horizon. It could impact a huge number of businesses.
Definitely something to watch. Now, the report also highlights the tax experience of some specific income groups. It points out people making roughly between $178,000 and $261,000. They face a significant tax burden. Why focus on this group?
Well, what's notable there is the average federal income tax rate for that income bracket in 2022. It was 14.3%.
Okay, 14.3%. Not the highest rate overall, but...
Right, but it's almost 5 times the average rate paid by the bottom 50% of earners.
5 times. Wow.
Yeah, so while the very top earners pay a larger percentage overall, this upper middle income group still carries a pretty substantial income tax load relative to a big portion of the population.
It really underscores the sort of tiered nature of our income tax system.
It does.
And when we zoom back in on the very top, the top 1% who earned $663,164 or more in 2023, according to the IRS, their average income tax rate was about 26.1%.
Which is 7 times higher than the rate paid by the bottom 50%.
7 times? That's a pretty stark contrast.
It really highlights the progressive nature of the federal income tax structure.
Right.
I mean, look at the actual dollars contributed in 2023.
Okay.
The top 1% paid $864 billion in income taxes.
$864 billion from the top 1%, and the bottom 90%.
The entire bottom 90% paid $599 billion.
That's a very significant difference in, well, who is funding the federal government through income tax?
It certainly is.
Of course, as the report rightly points out, federal income tax isn't the only tax we all pay.
No, absolutely not. We also have state taxes, local taxes, things like sales tax, property tax.
Sure.
You have to consider the whole picture.
So if we connect this to that broader tax picture...
Right. Even when you factor in all levels of taxation, federal, state, and local count, the data generally indicates that the total tax burden, if you look at it as a percentage of income, it's still generally higher for those in the higher income brackets compared to those at the lower end.
And what about the bottom 50% of earners? The report clarifies that in 2022, those making under about $50,400 a year, they paid an average federal income tax rate of 3.7%.
3.7%. And it's worth noting, the report explicitly states that there's no suggestion here of increasing taxes on this group.
Right. That's an important point of context. The focus of this report really seems to be on understanding the contributions at the higher end of the income spectrum.
Exactly. Not on just aiding the tax burden of lower income individuals.
So looking a bit higher up the income ladder, say 2021 data, top 5%.
Right. The top 5% of earners, so incomes above roughly $252,840, they paid over $1.4 trillion in income taxes.
$1.4 trillion, and that accounted for?
That was about 66%, 2/3 of all federal income tax revenue collected that year.
Wow, 2/3 from the top 5%. And if you expand that to the top 10%, those making $169,800 or more?
Their contribution jumps to $1.7 trillion.
Which is?
A whopping 76% of the total federal income tax collected.
76% from the top 10%.
Exactly. And to really underscore the concentration, the report emphasizes that the top 50% of earners in the U.S. contributed 97.7% of all federal income tax revenue.
97.7% from the top half.
Which means less than 3% of federal income tax revenue came from the bottom half of income earners.
So when you really step back and look at these figures, it highlights the complex challenge that our elected officials face, doesn't it?
Absolutely. They're tasked with funding the entire federal government.
Right.
And the vast majority of that income tax revenue stream comes from a relatively small segment of the population, proportionally speaking.
This raises a significant question, I think, about the intricacies of tax policy.
For sure. Balancing the need to fund public services with considerations of economic impact, perceived fairness, and just the reality of who is contributing what.
It's a delicate balancing act, lots of different perspectives to consider. So, okay, to kind of bring it all together then, this deep dive into the data from the IRS and Family Enterprise USA, it really points to a significant concentration of the federal income tax burden on those at the top.
It's actually within that top 1% of earners, yeah.
It certainly offers a different perspective than some of the narratives we often hear, wouldn't you say?
It does. The numbers themselves are quite striking, perhaps counterintuitive to some common assumptions out there.
And it really makes you think, considering these figures, What are the implications for our ongoing national conversations about tax policy,
Yeah.
about who should bear the financial responsibility for government services?
Hmm.
When you see this level of concentration at the top, what does that mean for the system's fairness, its sustainability?
And importantly, what will be the impact if that Section 199A deduction actually does expire for all those family-owned businesses?
That feels like a really critical point for further consideration, something maybe listeners can mull over.
Absolutely. It's a powerful reminder, I think, that digging into the data is just essential for having informed, productive discussions about our economic future.
So many layers to this issue.
Right. And continuing to explore and think critically is more important than ever.